Okay, so you want to open a cafe. Find a nice little unit on a busy high street, put some tables in the window, learn to pull a decent espresso, and watch the regulars roll in every morning. That is the plan in your head, and it does not sound unreasonable. Walk past any decent cafe on a Saturday morning, and it looks like one of the easiest businesses in the world to run. Every table is full. There's a queue out the door. The till is ringing constantly. You watch that scene and you think, this place must be doing brilliantly. Look how busy it is. Here's the problem. You are looking at the 1 hour of the week that lies to you the most. The truth is that a cafe is not really a food and drink business. It is a real estate and labor timing business that happens to sell coffee, and once you understand that difference, everything about how a cafe makes money and how it quietly loses money while the queue is still out the door starts to make sense. Let us start with what it actually costs to open the doors, because the price tag is far more layered than a coffee machine and some chairs. There is not one type of cafe. There are several, and each one is really a different business wearing the same apron. At the bottom end, you have the small, independent coffee shop, often under 600 square feet, run by an owner-operator with maybe 1 or 2 staff, typically turning over somewhere between 80,000 and 200,000 pounds a year. Above that sits the mid-sized cafe, the kind with proper seating for 30 or 40 covers, a small kitchen doing breakfasts and lunches, usually turning over between 200,000 and 600,000 pounds a year. Above that, the destination cafe or brunch spot, often in a prime location, built around a strong food menu and a longer dwell time per customer, which can turn over well over £1 million a year from a single site. And then there is the franchise coffee shop, operating under an established national or international brand, which sacrifices independence and a share of the profit in exchange for brand recognition, supplier deals, and a proven layout. Each of these is really a different bet on the same underlying question. Do you make your money from a high volume of quick, low-spend customers, or from a smaller number of customers who stay longer and spend more? That single decision shapes almost every other number in the business. Now here is where the naive mental model starts to break down. You think the expensive part is the coffee machine. It is not. The expensive part is turning an empty shell of a unit into a space that is legally allowed to serve food and drink to the public. A commercial landlord will typically ask for a rent deposit of 3 to 6 months up front before you have even started fitting the place out. And in a busy high street or city center location, annual rent alone can range from £15,000 for a small unit in a quieter town, up to £80,000 or more for a prime spot in a major city. Then comes the fit-out. A proper commercial kitchen extraction system, required by law for anywhere cooking hot food, can cost £8,000 to £25,000 depending on the size of the kitchen. Plumbing and drainage for sinks, dishwashers, and grease traps, another £5,000 to £15,000. Flooring, tiling, and general shop fitting to a standard that will survive constant foot traffic and spills, another £10,000 to £30,000. And then there is the part almost nobody budgets for correctly at the start, which is the coffee equipment itself. A proper commercial espresso machine, the kind that can pull consistent shots for 8 hours a day without breaking down, costs anywhere from £5,000 to £20,000 depending on the size and brand. And a commercial grinder adds another £500 to £2,000 on top of that. Add up the deposit, the fit-out, the equipment, the licenses, the initial stock, and a cash reserve to survive the slow first few months while word-of-mouth builds, and even a modest, mid-sized cafe can require £60,000 to over £250,000 just to open the doors, before a single flat white has been sold. So far, so good. Now let us talk about what can go wrong. And the next trap is a bigger one than most first-time owners expect. It lives inside the coffee cup itself. Here is the number that surprises almost everyone. The raw ingredient cost of a cup of coffee, the beans, the milk, and the cup, is genuinely tiny, often somewhere between 30 and 60 pence for a standard flat white. Sold at £3 to £4.50, that looks like an enormous margin, and on the ingredients alone, it is. But that ingredient cost is almost never the number that determines whether a cafe is profitable. The real cost sitting underneath every single cup is labor. And labor in a cafe behaves completely differently to labor in most other retail businesses, because a barista is not interchangeable with an unskilled till operator. Making a consistent espresso shot and steaming milk properly takes real skill and repetition, which means a trained barista commands a meaningfully higher wage than minimum wage retail staff, and a cafe needs enough staff on the floor at once to keep a queue moving during the morning rush. Even though that same staffing level would be completely wasted during the quiet mid-afternoon lull. This is the central tension of cafe economics. You are staffing for your busiest 15 minutes of the day, and paying for that staffing level across every single hour you are open, including the hours where 2 members of staff are standing around with almost nothing to do. Now, footfall and location. This is the decision most first-time cafe owners get wrong, because they assume a busy street automatically means a busy cafe. It is more specific than that. What matters is not how many people walk past your window. It is how many of those people are the kind of person who stops for a sit-down coffee rather than grabbing one from a chain on their way somewhere else. A location surrounded by fast-moving commuter foot traffic, people walking briskly to a train station, tends to favor quick takeaway sales and struggles to fill seated tables. A location near offices, universities, or residential streets with a slower, more lingering type of foot traffic tends to support the higher spend, longer dwell time model that mid-sized and destination cafes depend on. And crucially, rent in the UK is priced almost entirely on footfall volume, not on footfall quality, which means the most visible, highest footfall units are often priced for a volume of trade that a small independent cafe, without the buying power of a national chain, simply cannot generate on its own. Now we get to the part of this business that actually explains everything else, and it is the seating turnover model. Picture 2 different customers walking into the exact same cafe. One buys a takeaway flat white and leaves within 90 seconds. The other sits down at a table for 2, orders a coffee and a pastry, and stays for 50 minutes working on a laptop. Which of those 2 customers is more valuable to the cafe? On the pure transaction, the second customer clearly spent more money. But per minute of occupied floor space, the first customer is worth dramatically more, because that table could have served 4 or 5 takeaway customers in the same 50 minutes that one laptop customer occupied a single seat. This is the quiet arithmetic that sits underneath every cafe with limited seating, and it explains a huge amount of behavior that customers often find slightly baffling or even irritating, like time limits on tables during peak hours, or a gentle reluctance to let large groups linger for hours over a single pot of tea. A cafe with 20 covers physically cannot serve an unlimited number of people during its busiest 2 hours of the day. So every minute a table is occupied by someone who has already paid is a minute that table cannot generate any further revenue that morning. This is why many cafes have quietly restructured their entire floor plan around this problem, adding a small standing counter by the window purely for quick takeaway customers, while keeping proper table seating for the customers who are worth the extra dwell time because they spend more per visit. There is a seasonal wrinkle to this whole picture too, and it shapes the entire financial calendar of a UK cafe. Trade in most cafes follows a fairly predictable weekly rhythm, with weekday mornings driven by commuters and weekend late mornings driven by leisure and brunch trade. But there is a broader seasonal pattern layered on top of that as well. Cafes in tourist areas or city centers often see a genuine summer peak followed by a noticeably quieter winter, while cafes in residential or office-heavy areas can see the opposite pattern, with a January and February boost from people returning to routines after the Christmas break, followed by a quieter August when offices empty out for summer holidays. Experienced owners plan their entire cash flow around whichever pattern applies to their specific location, using their strongest months to build a reserve that carries the business through the predictable quiet stretch. The owners who get caught off guard are the ones who staff up and spend as though their busiest month were the permanent baseline, rather than the seasonal peak that it actually is. There is also a structural choice sitting underneath all of this, and it is the same one facing almost every small food business in the UK, which is whether to build an independent cafe or buy into a franchise. A franchise gives you an already known brand name, a proven menu, standardized supplier deals on coffee beans and equipment, and often a much shorter path to opening because the fit-out specification is already decided for you. That is valuable, especially for a first-time owner who has never run a food business before. But it is not free. Franchise agreements typically require an upfront franchise fee of £10,000 to £50,000, an ongoing royalty of 5 to 8% of gross revenue paid back to the franchisor every month, and often a separate marketing contribution on top of that. An independent cafe owner keeps every pound of profit the business generates and has complete freedom over the menu, the pricing, and the atmosphere. A franchise owner is permanently sharing a slice of the top line in exchange for the brand recognition and support system, which can absolutely be worth it. But only if the extra footfall that brand name attracts is large enough to cover what you are handing back every single month. Now, here is where the financial fragility becomes just as important as the daily takings. Why do so many seemingly busy, well-loved independent cafes quietly close their doors within their first 2 years? Industry figures consistently show that a very significant share of new UK hospitality businesses, cafes very much included, do not make it past their second or third year of trading. And the reason is almost never that people stopped wanting coffee. The reason is structural. Business rates, the local tax on commercial premises, can add several £1,000s a year on top of rent. And unlike rent, they are set by a formula based on the property's rateable value rather than on how much revenue the cafe is actually generating that year. Energy costs for running an espresso machine, a fridge, an oven, and lighting for 10 or more hours a day have risen sharply in recent years. And for a small cafe operating on thin margins, a large increase in a single utility bill can turn a profitable month into a loss, making one almost overnight. And food and drink a wastage, unsold pastries at the end of the day, milk that passes its use-by date, ingredients bought for a menu item that did not sell as well as expected, quietly eats into margins in a way that rarely shows up as a single dramatic cost, but compounds day after day into a genuinely significant annual loss if it is not tracked carefully. So how does a cafe actually make money, in plain mechanical terms, once it is past all of this? The core engine is simple: average spend per customer, multiplied by the number of customers served, minus the cost of ingredients, minus staff wages, minus rent and overheads. If a cafe has fixed monthly costs of rent, staff, utilities, and business rates totaling around £12,000, and it makes an average gross profit of around £3 on every transaction after ingredient costs. It needs roughly 4,000 transactions a month, or somewhere around 130 a day, just to cover its fixed costs and break even. Below that number, the cafe is losing money every single month it stays open. Above it, additional transactions carry a genuinely strong margin because the fixed costs of rent and the core staff shift are already covered. That is the good news. Here is the volatility that comes right after it. New cafes typically do not reach that break-even transaction count from day one. Building a loyal customer base and a reliable stream of regulars in a specific neighborhood can take 6 to 18 months. And every one of those months burns through the working capital reserve the owner set aside before opening. If a competitor opens nearby during that window, or if the initial buzz around the opening fades faster than expected, the runway can run out before the cafe ever turns a genuine profit. This is where a second revenue stream becomes essential for many independent cafes, and it is often wholesale and events. Selling coffee beans, roasted or bought in bulk from a roaster, to customers to take home carries a much higher margin than a made drink because it involves none of the labor cost of a barista's time. Catering small events, office coffee orders, or wholesale supply arrangements with local offices can add a steady stream of revenue that does not depend on walk-in footfall at all, and crucially, does not compete for the same limited seating that constrains the core cafe trade during peak hours. A cafe that relies purely on foot traffic through its own front door is entirely at the mercy of the weather, local roadworks, and whatever else happens to be happening on that specific street on that specific day. A cafe that has built even a modest wholesale or event side to the business has a genuine buffer against a single bad week of walk-in trade. Now, let us put all of this together and look at what actually happens over a full year, because this is where the two very different versions of this business reveal themselves. In the optimistic scenario, you have picked a location where the footfall genuinely matches your pricing model, kept your staffing tightly matched to your actual peak hours rather than overstaffing out of caution, built a loyal base of regulars who return several times a week, and added a small wholesale or event side to smooth out quiet periods. Under those conditions, a mid-sized independent cafe can generate a net profit margin somewhere in the healthy end of the industry range, translating into an owner's take-home that genuinely reflects the long hours and early mornings involved in running the business. In the realistic scenario, 2 or 3 things go wrong that are not exotic at all. They are the normal risks of this exact business. A new chain coffee shop opens 2 streets away and pulls away a portion of the quick takeaway trade with a loyalty app and lower prices. Energy and ingredient costs both rise within the same year, squeezing margins from both directions at once. A key member of staff leaves, and the cafe spends several weeks understaffed during its busiest period while a replacement is trained up. Under those conditions, that same cafe can slide from a comfortable profit margin into a break-even year or into an outright loss, even while the tables are still full most mornings and the queue still forms at the counter on a Saturday. And almost none of that swing shows up as a single dramatic event. No fire, no scandal. Just a slightly higher ingredient bill, a slightly heavier energy cost, and a slightly quieter Tuesday afternoon, compounding quietly week after week until the number at the bottom of the accounts looks nothing like the plan. So if you do decide to open a cafe in the UK, remember the one thing that actually determines whether you survive. It was never really about how many people you can get through the door. It is about how well you can turn your busiest 15 minutes of the day into a business model that still works during the quiet ones. If this kind of breakdown helps you see a business differently, that is exactly what this channel is built around. Subscribe to Money Framework British for more deep dives into how everyday businesses really make their money behind the scenes. And turn on notifications so you never miss the